We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Bob Elliot, co-founder, CEO, and CIO of Unlimited Funds, and former head of research and member of the investment committee at Ray Dalio's research team at Bridgewater Associates. How are you today, Bob? Thanks for joining me.
Good. Thanks for having me on.
So you taught an intro to macro and markets course that you have pinned to the top of your Twitter profile. And it goes through many of the big themes to help people understand things like money, business cycles, the interplay between productivity, business cycles, and the long-term debt cycle, monetary policy, what drives bond yields, and what drives corporate profits. And it's something I think anybody with any interest in the space should check out if they're trying to understand more on these topics. So considering, let's say, the three big forces of productivity growth, the long-term debt cycle, and the business/market cycle, how do you see our current economic situation? And maybe we can start there by laying out a little bit about how you see this current situation here.
Yeah, I happy to do that in that framework. I think if we think about from a longer term, the first thing you want to start with is basically, let's call it the longer term productivity cycle, which drives, anytime you're thinking about growth over 20, 30-year time frame, that's productivity is the main thing that drives what's going on. And we've basically, I think the thing that you typically see is the productivity, particularly in advanced Western economies, is pretty stable over time. There's some fluctuations here and there, but by and large, productivity is consistent. And that most of the evolution of productivity that you see, or the changes in productivity, are more cyclically driven and driven by other factors rather than real, true productivity dynamics. I do think there's a big, that being said, there is a productivity cycle, particularly in the context of a global, particularly in the context of the development of an overall, like a societal development, which is in the West, let's just say the developed West, we've gone from 75 years ago being innovative and hardworking to being less innovative and less hardworking today. And so you'd expect productivity to moderate. So the types of productivity gains that existed, in the 50s, 60s, and 70s are unlikely to persist. So we're seeing productivity slow to sort of that, 1% kind of level. Take labor force growth at close to zero in most Western developed economies, and productivity growth about 1, you actually don't need that much economic growth to have some tightening in the overall market. And I think that context is actually somewhat important when we think about what's going on, today, which is you see places like Europe or the US put up GDP numbers of, 0, 1, 2%. That is very different. That's not that bad. This in the grand scheme of things, and very different from where we were, say, 20 years ago, when a 1% growth rate or a 0% growth rate was actually quite a contractionary dynamic. And so it creates some risks around using previous cycles as benchmarks to looking at today's cycle. So you take that.
Sorry, Bob, if I could just interrupt you for one sec there. Yeah. When we're thinking about these, these labor force growth rates, is a lot of that just due to demographics?
Yeah, that's just a demographic issue.
Okay.
And, on the margin, advanced Western economies could possibly increase immigration to the extent that it could be beneficial to their labor force growth. But those things are pretty on the margin. They're, the big picture story for most of these economies is that they have aging populations. And the result of an aging population is you get lower labor force growth, and therefore overall lower overall growth, lower nominal growth, and real growth on a structural basis. That actually ties nicely to the debt cycle, because typically the way that economies that are in the later stages of labor and productivity cycle is you typically start borrowing to make up for the fact that you can no longer produce as high a rate as you did before to maintain a continued standard of living. And that's really what we've done in the advanced Western economies over the course of the last, say, 30 or 40 years. It was obviously helped a great deal by the fact that you had a secular decline in interest rates as inflation became more controlled relative to where it was back in the 60s and 70s. And that helped stimulate an incredible amount of debt growth. And that debt growth basically flowed into a fair amount of consumption, maintaining consumption growth that was stronger than underlying productivity plus labor force growth, and also flowed a lot into asset prices. And so if you look at things like housing prices, particularly if you start to look at places like Canada and Australia, the US, of course, had its cycle a little bit earlier, or the UK, a lot of that credit and that borrowing flowed into those asset prices, supported those asset prices in order to continue to basically spend and buy as much, houses as people had grown accustomed to in terms of the improvement of their quality of living. The problem with that is that there are natural limits to debt growth, in the sense of at some point you start to borrow so much that it's implausible given your income prospects that you'll be able to pay it back. And particularly if you think about the cycle, the long-term cycle, what you have is actually a declining structural ability to pay back the debts as you're increasing your debts. And we've really, that really came to a head in the US context, I'd say back in the 2008 cycle, and it has shifted meaningfully from that point. If you look at something like places like Canada and Australia, that sort of reckoning hasn't yet happened and is likely, is probably starting to emerge. Although, I would have told you that 10 years ago too, that it would probably emerge. So these debt cycles can play out longer than you might expect. Mm-hmm. And so that's kind of the underlying dynamic, which is, we're either past our debt cycle peak in the private sector or reaching those debt cycle limits. And then what we're seeing, particularly in the US, is that borrowing dynamic is shifting from the private sector, which is, mostly deleveraging or in that deleveraging longer term cycle. It's shifting to the government, right? As the government starts to borrow increasing amounts and start to increase their deficits in order to offset the dynamics on the private sector. And so now we're seeing governments start to borrow meaningfully. Really, if you look over the last 15 or 20 years, government debt levels have risen considerably. And that too has its limits. Governments can obviously borrow essentially in an unlimited capacity because they can print the money to be able to do it. But at some point, risks around the magnitude of their borrowing and the stimulative effect of their borrowing start to get raised, either in the price action or the sheer amount of money printing that has to get created. And in particular, what you often see is that fiscal stimulus coming to the market at a time when productive capacity is declining, which creates a squeeze on the basically a lot of nominal income or a lot of nominal income, with transfers relative to flagging productive capacity. And you often will get squeezes on prices as a function of that. And that, in a lot of ways, is what's going on right now in the global economy, and particularly in the advanced Western economies, is that we have a circumstance where there's been a lot of government borrowing and fiscal transfers, particularly in the US, but to some extent in other places. And that's created the nominal income or the nominal savings or assets that people can use to start to spend. And that's happening in the context of a structural dynamic where labor force growth is starting to slow and unexpected retirements sort of tip the labor market into deficit and create a very tight labor market, which is resulting in undesirable wage growth, which is then resulting in inflation. And so I think it's very important to recognize, some people will say, well, we're in an inflationary cycle because of COVID supply chain issues. And that is true. That was certainly a dynamic. And that's often what you see in these inflationary cycles, is that there's often a supply shock which accelerates or exacerbates the inflationary dynamic. But the big picture of what's happening is the productive capacity of the economy is going down a lot, and the desire to keep spending, particularly on a nominal basis and on a real basis, continues to remain, even though that productive capacity is going down. And that gap, which was filled with debt, that gap basically has to be filled with debt and money printing. And that's basically what has happened over the course of the last 15 years. And that eventually got to a point where that imbalance was so big that you started to not just see, real spending, you started to see pressure on prices. And that's really where we're at, which is a cyclical, we're in a cyclical inflationary cycle, which has been exacerbated by the context of the secular coming towards the end of the secular debt boom, and in the context of structural reduction in the productive capacity of the economy. All of those things are intersecting. And then we just had a crisis, a health crisis and a supply chain shock that just sort of, we just put that on top of all of this, which accelerated the whole dynamic much more significantly. And that's basically where we are today.
Mm-hmm. Well, there's a heck of a lot of threads to pull on there, and we'll try and get to all of them. But when we think of that wage growth / inflation cycle, and if wages keep growing, does that really become one of those situations that keeps driving the inflation if we keep seeing wage growth? And is that something that the government doesn't in some ways doesn't want to see?
Right. I think a lot of times people hear wage growth and inflation, they think wage price spiral. And that's not actually how it works. It's not a wage price spiral is typically occurs most often in the context of an emerging market cycle. And that's basically where you have a fall in the currency, which raises imported prices, which creates a real squeeze on domestic participants, which means that they demand higher wages, which means that they continue to overspend, which creates downward pressure on the currency, et cetera. That's not really, that sort of dynamic happens when currencies are falling, 20, 30, 40, 50%, like what's going on in Turkey and other Argentina, places like that. That's a wage price spiral, right? That's not what we're having here in the US or basically anywhere in the developed world context. What we're having here is a traditional inflationary business cycle, which, to be clear, we have not had since the 60s and 70s. So people are not particularly familiar with how these cycles work, which is that wage growth, like typically what happens is you have a supply chain or supply shock, prices rise, wages actually trail the prices, and over time, wages start to catch up to the higher level of input prices or prices that rose unexpectedly because of the supply shock. But almost always what happens is that real wage growth is negative through most of that cycle. And instead, what's happening is the increase in nominal wages helps maintain the nominal spending at a higher level, not create a wage price spiral, but maintain higher nominal spending. And that word maintain, I think, is really important, because when you think about, you or me or anyone, you have a job, you have income, right? You could possibly borrow. Like the fact that your income is rising in a nominal sense helps you spend more than you would otherwise. And so that's basically what's happening right now, which is you have this dynamic where, wage growth, nominal wage growth, let's say we're talking about the US, is growing at, somewhere between, 5 or 6 or 7%. We can compare that to the productive capacity of the economy, right? How much are you producing per hour worked that you're getting that incremental wage growth? That looks a lot lower than 5 or 6%, right? It looks more like 1 or 2%. And so that creates a structural inflation gap, right? That creates a structural inflation problem, which is I'm maintaining my nominal spending at a certain level, I'm producing at a certain level, and that's creating a price growth in these economies that is, undesirable, because there's a lot of second and third order consequences when you start to get inflation. As inflation moves from 2 to 3 to 4 to 5, you start to get some undesirable consequences, whether it's in the financial markets or in the volatility of inflation, et cetera. And so that's kind of the dynamic we're seeing, is that this elevated wage growth is maintaining nominal spending growth that's too elevated relative to the productive capacity of these economies.
And again, a much different case than if we had a 20 or 30% inflation rate.
Very, very different. That is a whole, you can kind of think about one of the risks, right? One of the risks that you have when you run 3 or 4 or 5% inflation is that the path to getting to 20% inflation is easier starting at 5 than it is at 2.
Mm-hmm.
But that doesn't mean that if you're at 5, you're going to go to 20, right?
Yeah.
That's not how it works. If anything, actually, in advanced Western developed economies with credible central banks, almost always inflation comes down eventually, right? It can take some time, but almost always inflation comes down. And so more it's an issue of some distortive effects in the economy when you get to that 4 or 5 or 6% inflation dynamic. You get some distortive effects. Partially, you get, frankly, like the menu cost problem becomes an issue. The fact that wages trail prices becomes an issue. You get negative real income growth, which is detrimental to people. And then also when it comes to asset markets and things like that, you start to get asset markets and financial assets in general trading on inflation expectations rather than like growth. Like, for instance, stocks and bonds, when inflation is above 3 or 4%, start to trade more positively correlated. That has second and third order consequences in the financial markets that are undesirable. And so you get some of these undesirable outcomes, but it doesn't mean we're going straight to 20% inflation just because we're at 5 or 6 or even 9 or 10, right?
Mm-hmm. So I want to go back to some of the debt equation and, reading from some of the, as I said, the Twitter thread that is pinned to the top of your profile, which I think is excellent. And it says, when debts can't rise faster than money and income forever, there are limits to debt growth. Think of debt growth that is faster than income growth as being like air in a scuba bubble. There's a limited amount of it that you can use to get an extra boost, but you can't live on it forever. In the case of debt, you can take it out before you put it in, i.e., you don't have any debt and you can take it out, but you are expected to return what you took out. And it continues a little later. When debt can no longer be raised relative to incomes and the time of paying back comes, the process works in reverse. It is that dynamic that creates long-term debt cycles. These long-term debt cycles have existed for as long as there has been credit. Even the Old Testament described the need to wipe out debt once every 50 years, which was called the year of the Jubilee. So how close do you think we are to the end of this debt cycle? And what would a debt Jubilee look like?
Well, I think, we're probably not going to have a debt Jubilee in this context. We don't quite have the centralized authority of the Old Testament days. But I do think what that highlights is the overall dynamic, which is, depending on exactly which economy you're talking about, there's been a great deal of leveraging up over the course of the last 30 or 40 years. Mm-hmm. And that was exacerbated in the last 15 by an era of, frankly, money that was, incredibly, the greatest monetary stimulation in economies, in the past hundreds of years, right? Mm-hmm. And so you had the circumstance where basically the debt cycle was, we sort of, let's say in the US context, reached the peak of our debt cycle from the private sector's perspective in 2008, right? With the housing crisis, et cetera. That then created a circumstance where, borrowers could no longer take on a whole bunch of debt relative to their incomes. And what did that mean? Well, the US had 15 years of stagnant growth as a function of that, very low real growth. And part of the way in which that played out is that the central banks, there's no Jubilee, right? Almost always there's no Jubilee. But one of the tools that central banks can use in monetary systems that are fiat based is to print money to basically offset the deflationary forces of debt so that you don't get debt contraction. So typically the way this would work in an environment where the central bank, let's say you were on a gold standard, just as a context, what would typically happen is that people would start to build up debts, right? And that would be expansionary. And then at some point, right, the debt dynamic would start to compress, and people would have to pay back those debts. But as they pay back those debts, their spending becomes lower than their incomes, which then, someone's spending is just another person's income, which creates the downward spiral of a debt contraction. And so that's why if you go back to, say, the 1800s or the early 1900s, you see a lot of these waves of debt expansions, and then they reach limits, and then you have big debt contractions. You have a debt expansion for 20 years and a big debt contraction for 20 or 30 years, and up and down and up and down. And that is very, that's destabilizing, structurally destabilizing, because frankly, it creates underlying volatility that makes productive investment less attractive, incremental productive investment less attractive. And so that's actually bad for the overall economy. And so what the use of a fiat monetary system does is the ability for the central bank, once you reach those debt limits, to print money. That printing of money is really important because it allows a cushioning of that deflationary force, right? So there's that deflationary force from the debt contraction. You cushion that deflationary force, and as a function of that, you get growth on the backside of the cycle, which is like not great. This isn't a great boom, but what it is enough of an offset of the deflationary force to make sure that you don't have a big economic contraction. If you look at Japan as an example, which has been going through this cycle over the course of the last 30 years, a lot of what, Japan, in the case where the BOJ didn't print any money over that period, would have been far worse than the fact that they did print some money. And if anything, you actually kind of get a sense of that, because you see in the 90s and up until the early 2000s, where they didn't print enough money to offset the deflationary forces. And it was actually quite contractionary in a way that was unproductive for the economy. And so now they start printing money to offset that deflationary force. It doesn't mean that Japan has an inflationary spiral. It just means that it isn't as bad, isn't as deflationary as it would be otherwise. The problem with that approach, and I'll wrap up on this in a minute. The problem with that approach is that if you create too much stimulation, right, then you have a circumstance where you start to get undesirable inflation dynamics. And that basically is what happened in this most recent cycle, particularly in the US, but across the developed world, where it's one thing to print enough money to offset the deflationary cycle. It's a different thing to run, massive government budget deficits funded by trillions of dollars of printing. And that creates, in a time when your productive capacity is constrained, that creates undesirable nominal spending and inflationary effects. And we're dealing with the consequences of that right now.
Mm-hmm. Bob, couldn't the argument be made that if we were on, let's say, more of a commodity backed type currency, and we do get those, quote unquote, destabilizing reversions in the cycle, that those are a little bit more overall tolerable to the market rather than the fiat based system of stimulating, and then we have an extremely, large destabilizing, maybe deflationary event like 2008, for example. Do we see ultimately, very likely, larger, more destabilizing effects from that fiat system rather than smaller, more frequent ones?
Yeah, I think it's a good question, and one that in some ways is an unanswerable question, though. I think the basic idea of what you're trying to do when you're trying to set up a monetary system is create a circumstance that generates the most productive investment over time for the economy. Because if you go back to those three different points, like the thing that drives long-term wealth creation, income creation, is productivity and labor force growth. And the strategic question you want to ask yourself is, how do you create the most amount of productive investment that you plausibly can in order to raise incomes over time? And I think one of the challenges of something like a commodity-based system is that it creates a circumstance where there's a great deal of uncertainty around the pace and the timing, the frequency, and the pace of those destabilizing events, right? And so you create, if you're thinking about investing in productive capacity, say, it's 1850 and you're building a railroad, you sit there and you say to yourself, well, it's possible that, in the relatively near future, we could have a circumstance where, nominal demand in the economy goes down 50 or 70, 50%, right? I mean, that's not a totally unusual circumstance in those periods, not that nominal demand goes down 50%. And so how do you navigate that? That's a very difficult circumstance to navigate. Now, on the other side, if you think about a monetary system, you have a lot more flexibility to respond to those dynamics. But the risk you have is you take it too far and create destabilizing inflationary dynamics. And so there's trade-offs between these 2 points. I think in a lot of ways, the fiat monetary system, while it raises that risk of an inflationary dynamic, it gives you the tools to offset deflationary dynamics. And that really you can always cramp down on inflationary dynamics. That's important. That's very, very important, right? Mm-hmm. You might be late, you might not do it enough, all of those things, but you can always tamp down on those because you can always tighten monetary policy to bring that inflation down. Like, look, if the Fed wanted 2% inflation tomorrow or lower than 2% inflation tomorrow, it wouldn't be that hard. They could just tighten rates to 15% and we'd get there in a heartbeat, right? It's not that complicated. If they want to get if that's what their primary goal is. What it does give you is the flexibility to respond to deflationary events to ensure that you don't get that deflationary downdraft, and that when people are pricing the longer term investments, they can basically price out that whole bottom half of the plausible range of outcomes. And that creates a lot of stability in the economy structurally, even though at any point in time, we might have too much debt. We might have a crash as a function of that. We might have to print money. There's an outside chance of inflation being too hot. But I think I'd take that combination of risks relative to the risks that exist in a commodity-backed currency dynamic.
Interesting. So, Bob, there's a distinction that you make in that writing between recessions and deleveraging events. So, can you give us, let's say, the nuts and bolts of the differences between those?
I think typically when you think about a recession, you could think about there's ebbs and flows or cycles in incomes, right? Typically related to your income growth is typically higher in times when labor markets are tighter. Your income growth is typically lower when labor markets are less tight. There's also waves of borrowing. Sometimes you're borrowing more because interest rates, are low and opportunities abound. Sometimes you're borrowing less because interest rates are high and opportunities are not available. And those sorts of dynamics, right? I'd say those ebbs and flows in income growth and ebbs and flows in credit growth are sort of normal business cycle activities. When you get to a deleveraging, what you're seeing is an active paying down of debt, right? Paying down of debt at an economy-wide level that creates a deflationary spiral downwards. And that is a very different dynamic because what you have there is that people aren't adjusting. Essentially, they're not growing more or less in terms of their incomes or their spending. What's actually happening is they've created a big gap between the amount of spending that they're doing relative to their incomes, meaning that they're spending a lot less than their incomes, right? Which in order to pay off their debts, and if they're spending a lot less of their incomes to pay off the debts, that's translating to lower incomes from other people, and that's the spiral, and it gets often exacerbated by deflation, which incentivizes people to hold cash today on the expectation of higher buying power in the future. That's why that sort of zero bound is really important, because it flips the incentives, right? The incentives in a normal economy, when you have let's say 2% inflation, is, I know every day that there's cash in my pocket or, cash in my checking account. I know that it is getting worth less every day, right? That you know that. And whether you explicitly think about it or implicitly think about it, it is constantly a motivation for you to go out and either spend on stuff or more likely spend on financial assets, right?
Mm-hmm.
Which is beneficial because spending on financial assets means that someone gets the money. It means someone takes that and invests it in productive capacity in one shape or form. The risk in a debt deleveraging paired with deflation is that you have people who hoard cash on the expectation of higher value in the future, which reduces the investment in productive capacity today and creates, structurally, that is a bad outcome, right? You want people to invest in productive capacity today to raise long-term productivity opportunities and productivity growth. And so that's sort of the dynamic that's a deleveraging, which is very, very different, because that can be a self-reinforcing dynamic that's very negative in the economy structurally,
and much
which is very
longer
different
too, right?
And could go on for much longer and things like that. That's very different from this, the cyclical waves in income and in credit that you typically see in a business cycle.
So after reading several books on the Great Depression, it seems to me like many of the solutions that the government and the central bankers intervened with actually exacerbated the problems that the economy and the markets were facing. Is this a fair judgment?
Yeah, I think you could think about the depression dynamic as sort of two different periods. One where the response to financial instability or financial deterioration was we should tighten our belts, right? And I think that's actually quite the reason why you often see folks in central banks facing a debt deleveraging cycle initially respond using that set of tools is because for any one individual, that's the rational choice, right? The rational choice is if you've borrowed too much and you're spending too much relative to your income, then what you should do is you should reduce your spending relative to your income and pay back your debts, right? That actually, like from an intuition perspective, makes a lot of sense, right? There's reasons why when people see the government borrowing too much, they say what we should really do is implement austerity, right? The problem with, and that was like, I mean, it wasn't just to be clear, like, it's not just, those silly people back in the 1920s implemented austerity in response to debt deleveraging. Like Europe did exactly the same thing in the 2010s, right? So it's not like this is, some totally foreign way of approaching it. It's very typical. It's a very typical way of approaching it. The problem with that is that it fails to take into consideration that one person's spending is another person's income, and if everyone is tightening their belt at the same time, then you have this core problem that everyone is trying to cut their spending all at the same time, which is cutting everyone's incomes, which is having second and third order effects. And so this is typically what you see the initial move to austerity, thinking that will solve the problem because of that individual intuition. It exacerbates the problem, right? And as a function of that, then you get into a worse problem. And when you get into that worse problem, the only solution to that problem, and this is really what's called the second half of the depression period, is the only way to deal with that problem is to reliquefy in one form or another, right? And so that involves, there's a bunch of different steps to deal with that, but things like money printing, which is more in the modern context, or back in the 30s context, devaluing money relative to gold, which is really devaluing money relative to stuff, right? The real productive capacity of all the stuff in the economy allowed people to get out of that negative downward spiral. The key question is, you want to do that, you want to do enough of that to offset the deflationary force, but you don't want to do so much of it that it creates a circumstance where money is being devalued too much, and you start to run into issues with, the exchange rate and overall inflation. But almost always in these circumstances, what you see is that the central banks do too little for too long to get things going. Like Japan is a perfect example. It has been 30 almost 35 years, right? It's kind of incredible. I remember initially teaching Japan, it had been, well, it's for 15 years. They've been stuck in a deflationary trap. Now it's 20 years later. And for 35 years, they've been stuck in a deflationary trap. And that's a good example. Like Japan doesn't have an inflation problem right now. It hasn't had an inflation problem in 35 years. Like, if anything, people are doing too little, not enough, in dealing with these debt problems, because there's always that pull for austerity in these dynamics, and people don't recognize the second and third order consequences of that austerity.
So, using Japan as a good example here of a government that has gotten to a debt level where they have to start, in some ways making the choice between defending the value of their bonds to the detriment of their currency or vice versa. How is that working for them? Like, how does that dynamic work from the outside, from an observable point out here?
Yeah, I think that the main question when you think about the tools that you can use to reflate your economy is the primary tools are in a fiat system is to be printing money in order to offset the deflationary forces. And the primary limits of that are a point in which you print so much money or you create sufficient stimulation that it starts to create concerns for foreign investors who have the risk of pulling their money out, or creates concerns around domestic investors that their currency will no longer be a storehold of wealth. I think it's a really important, when you think about the Japan circumstance, it's very important to recognize Japan in many ways, because they've kept such a deflationary force in their spending so modest. Japan is a structural creditor in the global economy, not a structural borrower. And so, and also, just given the nature of the economy, there actually isn't, there's not a lot of foreign demand for Japanese assets and things like that. And so Japan is actually in a relatively advantaged situation in terms of running a stimulative policy, because the risk that you're going to have a big withdrawal of capital from Japan is relatively modest, because there isn't a lot of foreign liabilities and because they own a lot of foreign assets. And similarly, when you have a deflationary dynamic, the real risk that domestic folks start to move money offshore is pretty low, because in a lot of ways what they're doing, what are you going to do if you're in Japan and you had this years and years of deflationary dynamics where your cash has actually done better over time rather than worse? Like, the odds that you're going to be like, well, you know what I should really do is go buy dollars, and you're like, well, is that real? Like, that's not really their natural state. And so you have this circumstance where if anything, Japan could use a lower currency, more stimulation in a lower currency, right? Which is I think it's very important. People get confused about Japan. They say, oh, well, Japan's following the US path right now. No, Japan looks nothing like the US. Like, Tokyo CPI, X energy and food is zero. It's been zero. It's been zero for 30 years. It's still zero. This is not an inflationary dynamic. So if anything, Japan could use more stimulation and a cheaper currency, because those sorts of things create competitiveness for the economy, for an incredibly depressed economy. And those sorts of things are structurally beneficial to kind of get some of that inflation into the economy and create and break that cycle a little bit. And they know that. Like as an example, there's a reason why they continue to run the easiest monetary policy in the world. It's because they know that is the right monetary policy given their circumstances. The real problem in Japan is that the fiscal authorities haven't been sufficiently expansionary to help basically leverage the monetary stimulation that's going on and create enough of a demand driver to create that domestic, get out of that deflationary cycle in the domestic economy and create that self-reinforcing upward move in terms of nominal demand. And so that's the basic idea. It's true that the Ministry of Finance intervened in the currency, and actually have been seen to intervene in the currency here and there. But that's more because you don't want that move to be disorderly, right? What you don't want to have is everyone sells the currency every day and it's a straight line bet, and then it just kind of spirals on itself. So that's a very reasonable set of approaches to that problem. But it doesn't mean like the yen at 150 is good for Japan. The yen at 160 or 170 or 180 or 200 would be good for Japan. It is the policy that they need. They just need to get there in a way that is not disorderly.
But it's really interesting to, in the way that you laid that out, now lay on top of that their demographics and their basic, what's the word I'm looking for? They're basically non-immigration status. They don't let new people immigrate. And if your population just keeps aging and aging and aging, and your productive capacity because of your demographics keeps going down, that seems like a counteractive force to their monetary policy.
Right. I mean, it's a huge, they face those are structural deflationary forces, which require, because what the things that you're describing, which is the aging population, reduces nominal incomes, and of course debts are in nominal terms. So the fact that your nominal income is falling is really a big deal. Like the combination of the deflationary dynamic plus the terrible demographic circumstances means that your nominal incomes on a forward-looking basis are likely to go down. And so, the productivity growth is actually not that bad. Like if you look on the, Japanese output per worker per hour is actually, pretty good, all things considered. It's just the problem that the number of workers that are coming into the economy are contracting a lot, which creates a very weak baseline number. And so they've got to figure out a way to increase nominal incomes because they have nominal debts, because they have to get nominal spending up. And there's just a bunch of different ways to do that. They could, part of Abe's three arrows was to increase labor force participation for women, which is sort of a chronic, it's an area in the Japanese economy where, there's obviously a fair amount of productive capacity that could be, could exist if you brought more women into the workforce. I think that was a good idea. It didn't really play out that well because it's hard to change various cultural norms associated with that. Mm-hmm. Similarly, one of the arrows was around immigration and skilled immigration, which also is a good idea. But the trouble with that in an economy that and a cultural, structural cultural dynamic that has eschewed engagement with the outside world through time, and has been a relatively closed economy when it comes to immigration, just means that it's just very challenging to break those norms. Those are the paths to success there, right? In the same way, in many ways, the U.S. economy has, or the Canadian economy, have both been radically benefited by continued immigration growth. Maybe not tactically, because it's around COVID and stuff like that. But like, if you look over the last 20 or 30 years, like immigration growth has been an important component of continuing to create a reasonably strong level of nominal growth and nominal demand in these economies. And so that really is, that's a path. When you have an aging population, is to bring more workers in the workforce in order to improve your overall nominal income growth. Mm-hmm.
Yeah, it's just kind of striking me as we're having this conversation, and I'm trying to stay with you on all these things. It's like, it really comes down to, we just need to continue to keep growing and growing and growing and growing and growing, unless we don't. And then what happens?
Yeah, well, I mean, I think that's the basic focus, is what are all the different steps that an economy, that policymakers can take in order to improve the long-term productive capacity of the economy, because that's the thing that matters the most in terms of getting from where we are today to what things will look like 20 or 30 years from now. And so each one of these different factors, there's basically dynamics that drive sort of the structural underlying forces there. And then there's policy response to those forces that can help, can either improve that dynamic, or it can exacerbate those dynamics. And so that really, really when you think about, and I should say, and how these various economies respond with that policy mix is the thing that's going to meaningfully drive whether or not they're successful over time. Like part of the reason, people have talked about, let's say, American exceptionalism over the last 15 years coming out of the financial crisis. Well, is it American exceptionalism, or is it the fact that we developed and implemented a set of policies, both fiscal and monetary policies, that were a better set of fiscal and monetary policies than how other places in the world responded, and why Europe was basically behind the curve in responding to their debt problems and the risks associated with that, or the US was creating more structural reforms, immigration, all of those different points. Is that exceptionalism, or is it just more effective policy on both the fiscal and the monetary sides of things to create a better outcome, given the hand that the developed Western economies were dealt? The US frankly just handled that hand a lot better than did many of the other economies in the world. And that is an important reason why there has been exceptionalism in the US, or strength, returns of US stock markets much better than the rest of the world over the course of the last 10 or 15 years, was a function of those policies, not a function of some, grand ethos. It was a function of policy given the dynamics that were faced in order to handle those dynamics effectively.
So maybe if we can, Bob, let's drill into, some of the things that we've seen happen. Do you think that the Fed has handled the decisions and the hands that it has been dealt? Do you think that it has handled things appropriately for, let's say, the last 2 or 3 years here?
I think the Fed really, the Fed was behind the curve in terms of recognizing the inflationary problems in the economy. I empathize with their circumstance, which I think was challenging because of all of the unknowns that existed. When those COVID happened, we hadn't seen that in 100 years. Supply chain shocks emerged. It was hard to know when they were going to get resolved. It was also hard to know what the second and third order consequences of those things were going to be. And so I'm not saying it was easy. I'm just saying, it was a challenging hand that they didn't quite play as effectively as they needed to. And I think in particular, the lesson learned from the last couple of years for the Fed was stay away from managing monetary policy based upon predictions. In that case, the prediction was inflation was going to be transitory. It was not transitory. And I think if you sort of see what the lesson from that is, I think a number of people take away that the lesson that the Fed has from it is be tight, or tighter, bring in the spirit of Volcker to run monetary policy because you weren't tight enough in the past. That's not what the lesson is. And I think it's actually a very important, very, very important understanding for people when they think about how monetary policy would play out. The lesson for the Fed was don't predict what's going to happen, respond to the data. Mm-hmm. And we see that dynamic tactically, like the last press conference. What Chairman Powell was saying was, I see inflation falling. I see growth slowing. Therefore, we're going to slow down the pace of our hikes. Now, think about that. Think about that. There's all sorts of people responding. He's looking at the data that's coming in and he's responding to it, mm-hmm. right? And there's all sorts of reasons. If I had to bet what I think inflation is going to do in the future, or I bet if he had to bet what inflation is going to do in the future, is that there will, we went from transitory inflation to transitory disinflation, and it'll probably go up in the future. And there's reasons why that might happen, particularly tied to the strength of the labor market and the stickiness of inflation. Okay, but he's not making a bet on that, right? Because he got burned by predicting. And so what he's doing instead is he's saying, I'm seeing the data, I'm responding to the data, and I'll just keep doing responses to the data. And I might be behind the curve, but I won't royally screw this up by predicting what's likely to happen.
But, considering the fact that we just saw the fastest rate hiking cycle in history, how long do you think that those actual effects are going to take to be fully felt by the economy, by companies' balance sheets, by the labor market, all of that?
I think it's a good question. And one of the things that is really challenging in this cycle is that you have a circumstance where we have not seen a traditional business cycle really since 2000. And even that was a bit of a bubble pop cycle more than, it was a bit of traditional cycle and a bit of a bubble pop. So, what are we talking about? Like late 80s, early 90s is the last time we've had a more traditional business cycle. And I think in that context, it's very uncertain. There's a lot of uncertainty about how all of these dynamics play through. Like the US economy, as an example, restructured substantially following the financial crisis, a move away from floating rate mortgages. A lot of companies basically went from borrowing on the short end primarily to extending duration, locking in low interest rates for a long time. And so there are reasons on that side why you might think that the sensitivity of the economy is lower today to interest rates relative to what it was in the past. At the same time, debt levels are higher than they were, certainly in 2000 or back in the late 80s and early 90s. And so you may think the economy is more sensitive to the interest rate dynamics. And so you see these big cross-cutting forces. And frankly, the big thing is it's unknown. It is anyone who tells you it is certainly this way or is certainly that way is too confident. Mm-hmm. There's a lot of ambiguity. So what is the right terminal rate to start to ease inflation pressures? It could be 3, it could be 5, or it could be 7, or it could be 11. Mm-hmm. It's hard to know. And so in a lot of ways, when you're navigating through this cycle, the key thing that I think you have to do is you have to be hold very true to the data and what you're seeing in the data, because it's telling you, it's giving you feedback on here's how much they've tightened, here's how it's flowing through. Is it actually doing enough? Is it not? And how is that working? And you got to operate agilely in this environment. You can't just say, well, there's been a lot of hiking and therefore, and the yield curve's inverted and therefore, you know what, we're going immediately into recession. The reality is lots of people who did that have gotten burned in the first part of this year because they used, frankly, indicators and dynamics that had existed years and years ago to try and assert certainty around the fact that we were on a certain economic path. And the reality is that it's a lot more ambiguous than that. So that's probably an unsatisfying answer to your question.
Well, I
think
think
a lot more uncertainty than there was in the past.
I think the basic premise that we should take from that answer is, as you said, we have to be nimble and we have to keep learning, right? We have to keep our minds open to continuing changes within the economy and each of these inputs and how they affect every piece of the economy.
Exactly. You got to. This is a time to not rest on your laurels or just assume that you know how this is working. It's a time to be open to the various possibilities. And I think from the perspective of managing money, it's very important to recognize that given this uncertainty in the macro environment, it's not a time to be a hero, to make a hero's bet on one particular macroeconomic outcome relative to another, because it's very plausible that we could get any one of a number of macroeconomic outcomes, whether it's a relatively fast hard landing, whether it's higher for longer, whether it's a soft landing, things like that. You could have your odds in terms of the probabilities of each one of those things, but the odds of each one of them is nowhere close to zero, nor is it close to 100%. And so you should be navigating and placing your bets in a diversified way that reflects the fact that any one of those outcomes could plausibly happen.
Mm-hmm. Yeah, and like we've heard from many of the top, let's say, hedge fund managers or investors, this is one of the most challenging environments that they've ever seen, right?
For sure. I mean, part of what we do at Unlimited is what we're using machine learning to infer and understand what positioning hedge fund managers have on in close to real time. And I think one of the things that has struck me over and over again through the course of the last basically year plus is how little risk hedge fund managers are running right now relative to history. In fact, hedge fund managers in general are running the lowest risk that they've run in 25 years. Hedge fund managers today are running the lowest risk that they've run over the course of the last 25 years, other than, say, the acute crisis period of 2008, or the depths of the COVID dynamic. And so I think it's very important to recognize, like, these are folks who have access to all the incredible tools, data, insights, understanding, and how are they positioned? Uncertain. That's how they're positioned, right? That's the most overwhelming position that they have on right now is a sense of uncertainty. And if that's the case, you have to think about what is your level of confidence relative to the level of confidence that many of these asset managers are able to have, and they're making sure not to swing for the fences. They're playing conservative through this dynamic, and so I think it's a good lesson that sometimes you don't know, and you have to be nimble, and you have to be responsive, and you have to recognize that not knowing when you're running money and play conservatively through a challenging environment. Because the goal here is not to make the trade of the century. The goal here is to continue to live to fight another day.
To not get killed, yeah.
Right.
So, when we take a step back and we analyze things from a longer term view, and maybe this more of a defensive posture that a lot of these big investment firms have taken, do you think that gold would be an asset that you would hold only in certain economic scenarios?
Well, I think gold is a great diversifying asset that's widely underheld. And the reason why that is that gold is particularly valuable in protecting against tailed environments, whether it's elevated inflation or inflation that is or deflation. Either one of those circumstances is a good. That's really what gold's benefit is a hedge against those tailed environments. Mm-hmm. And often people, for gold in particular, will look at the daily returns and they'll say, well, it kind of looks like interest rates, the shifts in interest rates or the dollar, which is absolutely true. And the reason why that is gold is non-interest bearing money. And so if you're looking at gold priced in interest bearing money, when that interest bearing money earns more interest, gold looks like a worse asset tactically. And so if you look at any rolling 7-day period or something like that, like gold looks like interest rates. Absolutely. The issue is gold can meaningfully diverge from interest rate returns, right? Bond returns over longer periods of time when the pricing of the tail risks in the economy start to become more elevated. And that's exactly what we saw over the course of the last year is gold's rolling daily correlation to interest rates basically is unchanged. It's the same it's been for a long time. But gold in 2022 was flat. And as an example, longer term tips or real interest rates declined about 20%. Right. So that's a huge, if you think about that, right? What should have happened is gold should have fallen 20%, right? Reflecting the higher real interest rates in dollars that existed at the end of the year relative to the beginning of the year, but instead it was flat. And what does that mean? That means there's a big pricing of tail risk. I think a very plausible pricing of tail risk that got priced into the gold market and is reflective of the fact that gold as a tail risk asset is looks better today than it did 12 or 24 months ago.
Mm-hmm. Excellent, Bob. Well, I think maybe we should leave it there for today. There's a million different other subjects we could get into, and I really appreciate you coming on and sharing your explanation of all these different things with us. I look forward to the next time we chat because you do such a good job of explaining these things. Is there anything that you want to mention before we wrap up that maybe we didn't touch on?
No. I thank you so much for having me. If people are interested in following my ongoing thoughts, probably the best thing to do is to check out my Twitter. I'm pretty pretty active there at Bobby Unlimited. And if you're interested in what we're doing at Unlimited more generally around replicating hedge fund industry returns, definitely check out our website at unlimitedfunds.com.
Absolutely. And we'll make sure we put those in the show notes, both of those links, and also the link to the articles that we kind of talked about.
Perfect. Well, thank you so much for having me. Really enjoyed it.
Thank you, Bob. I really enjoyed it too. We'll talk again. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.